Good morning, everyone. Welcome to the half-year results for the John Lewis Partnership. I'm Chris Wynn, I'm the Communications Director for the Partnership, and I'll be comparing today's call. There's plenty of time for questions at the end when we get there after a short presentation. Please do raise your hand and we'll get to your question. Joining me today, we have Sharon White, Chairman of the Partnership. We have Nish Kankiwala, who is our Chief Executive. We have Bérangère Michel, who's our Executive Director for Finance. We have James Bailey, who's our Executive Director for Waitrose. And we have Kathleen Mitchell, who's our Commercial Director for John Lewis. Unfortunately, Naomi couldn't be with us today. She has a long-standing travel commitment and isn't in the country. But sends her apologies. I'm first going to hand over to Sharon White, our chairman.
Thank you. Thanks everyone for joining this morning. We're delighted to be joining you from Peter Jones today on I have to say very, very sunny Thursday. John Lewis and Waitrose, two of Britain's most trusted brands. Partnership, the biggest employee-owned business in the UK, amongst the biggest in the world, and we are coming to the fourth year of a 5-year partnership plan. The cost of living crisis, hopefully you've had a chance to take a look at some of the materials today, but the cost of living crunch and also higher than expected investment requirements mean that the partnership plan will take longer and the transformation will be deeper and more pronounced. I just want to take just a moment just to explain what that means. So the plan will take 2 years longer to get to what we call in the partnership sufficient profit, or our target optimal profit, which some of you will remember previously we set at £400 million. The partnership will be profitable long before then. So I just wanted to cement that as colleagues go through the presentation and in the context of the Q&A. The partnership has a long-standing productivity challenge. Between 2000 and 2019, when we expanded stores and online operations rapidly, the number of partners grew by about 20,000, and yet profits flatlined and profit per partner unfortunately was significantly squeezed, and that hugely matters for us as a membership organisation. And in addition, bonuses were high, but the debt ratio was rising in the background. That productivity deficit has been thrown into sharp relief by the cost of living crunch. Nish and Bay, James, Kathleen will talk about how we're upweighting our transformation to meet the challenge, but also the opportunities of this most competitive of retail markets. We have a long road ahead, but things are improving, and I, for one, remain very optimistic. The balance sheet is strong, and there's a partnership trying to put people first, always, our partners and our customers. We're not perfect, but the values of the partnership are a strong motivating factor for our partners and customers. And what I hope you see is that our values run as a golden thread through the plan, whether that's high animal welfare standards that James will talk about, or the sustainability strong and getting stronger in John Lewis that Kathleen will talk about, or some of the support that we're giving to our partners, things like apprenticeships and skills and development, or the special new programme we've got to support young people in care coming into the partnership. So I'm going to pause there, and I'm going to hand over to Nish and first half year results.
Thank you, Sharon. Yes, well, made very welcome. Good morning, everybody on the other end of the phone. I'm going to, with the team, take you through an update on two things: our performance in the first half, and also an update on our transformation plan that Sharon talked about. So in terms of our performance, I do think the first half has been encouraging in terms of our financial progress, narrowing losses both post and pre-exceptionals, with good cash flow, and Bay will take us through more details on that in her presentation. From a trading perspective, I think we have some good positive momentum in the first half of the year. I'm delighted to share with you that 600,000 new customers came to our shops to give us 21.4 million customers that shop with us, which is fantastic. Our partnership sales went up 2% to 5.8 billion, and that was based on Waitrose sales growing 4% and John Lewis sales down 2%. And James and Kathleen will take us through some more details on that. As Sharon highlighted, we continue with our transformation plan, and building productivity and delivering productivity is a key part of that. And in the first half, we delivered cost efficiencies of £31 million, and we're in track for delivering £100 million this year, which is very encouraging for the plan. In terms of the overall transformation, there's three areas that I wanted to highlight. Firstly, we continue to simplify our business, whether it be in Waitrose as we're trialling our simpler shops, which is fundamentally about making sure we have the right partner hours when our customers want them, and that only reduces efficiency but also improves our customer service. In John Lewis, it's about simplifying our range, and that's going to be important as we look at productivity there. So simplifying our business continues to be a key plank of our transformation plan. The second area is reinvesting margin, working with our key suppliers to improve margins, both for goods for resale and also goods for not for resale. And a number of suppliers have helped us to deliver that margin, and that has been helpful, for example, in our ability to invest in reducing prices in Waitrose as part of that campaign, which has been very successful, that James will take us through a little later. And finally, it's about making it easier for customers to shop us. And that's about making sure, for example, in Waitrose, it's continuing to expand our convenience via expansion in Dobbies, Deliveroo and Uber Eats. Whether it's about increasing our click and collect points, where we increased to over 5,000, which are really important in terms of being able to get John Lewis products close to home. Also in terms of launching Scan Pay Go, which for some customers is an even more efficient way to basically shop at Waitrose. And also launching interest-bearing credit, which I think will make access to our purchases more affordable. So good progress in the first half of the year, both in terms of performance and also in terms of our transformation plan. And with that, I'm going to hand over to Bay.
Thank you, Nish, and good morning, everyone. So I'll be sharing headline number first. In the first half to the end of July, the partnership made a loss before tax and exceptional costs of 57.3 million, which is a 14% improvement on last year. I'd like to point out that we are using a restated comparator for the last half year. So at the last half year, we recorded as operating expenses an impairment in the value of our shops worth 25.6 million. But as these impairment charges grew in scale over the year, they were reclassified as exceptional costs for the full year results last year. Therefore, to ensure consistency, last year's half year results before exceptionals have been restated. You can see that on the left-hand side of the chart, from a reported loss of 92.4 million to a restated loss of 66.8 million. This has no impact on results after exceptionals, and all numbers in this set of slides are presented like for like. For clarity, there have been no impairment charges this half year. Including exceptional costs of 1.7 million relating to our efficiency programme, which is called Lean, Simple, Fast, losses before tax for the half were 59 million. This is an even greater improvement of 41% compared to last year's £99.2 million loss before tax. I'll now take you through the drivers of the improvement in the position before exceptionals, which you can see on the graph. Firstly, Waitrose trading operating profit has increased by 72.7 million which is 17% up year on year, and John Lewis's trading operating profit has decreased by 17.9 million, which is 6% down, and James and Kathleen will tell you more about this shortly. Underpinning both of these results were 31.2 million of additional efficiencies that I'll set out in more detail in a moment. And while inflation is softening, it still continues to impact us, and particularly within property costs, which were up 22.8 million, with electricity and gas bills the lion's share of this increase, and that's in part because our hedging has started to unwind. We have also made the choice to invest in our transformation, resulting in a step up of 21.4 million of non-recurring operating costs, mainly linked to the delivery of our Lean Simple Fast plan, which I will talk about in a bit more detail now. Thank you. So we're on track with our efficiencies. This half year we've delivered 31.2 million, 5.5 million through margin improvements. So this is much to do with range optimization and technology investment, particularly in stock management. 15.7 million in supply negotiation, for example in freight costs, and this also includes agreeing lower rateable values on property, which means lower business rates cost, and 10 million through simplification. That's principally the flow-through benefits of changes made last year to shop management structures. So at the half year we said we had achieved the £300 million efficiency saving that we had originally included in the partnership plan back in 2020, and benefits this half therefore bring the annual benefit delivered to date to 327 million, which is the first column on the left-hand side of the chart. We expect this first half benefits of 31 to triple by end of year to over 100 million, which would take us to about 400 million pound of annual benefit delivered, well on the way towards the 900. We have confidence in the 100 for this year because about 3/4 of the benefit have already been delivered, even though they're not yet realised in our numbers. So for example, that would be where we've signed a contract, but the benefits of what we've signed will only flow through our results as time passes. Examples of benefits that have yet to be realised in the second half include our recent announcement in relation to improving how partner hours match customer footfall in Waitrose shops, or seeing through the benefits of further automating our supply chain in John Lewis, which will enable us to process customer order faster and consolidate them into fewer parcels. And therefore both these changes will benefit customers too. When we announced our full year results last March, we explained we had adapted the plan in light of inflationary pressures and were now aiming for £900 million of efficiency improvement. So that's an additional £600 million. And we have plans to achieve this while continuing to deliver great customer experience. Moving on to liquidity, our financial health remains strong. We have liquidity of 1.3 billion, so that's £900 million in liquid cash and £420 million of credit available, which we have not needed to use this half or even ever before. Liquidity has decreased by 138.9 million, so that's 10% down since year end, but a decrease is usual at the half year because of the seasonality of our business. In fact, the partnership generated cash from its trading and operations, so that's 97.4 million, and that's an improvement of 76.7 million compared to the first half of 2022. Now we've generated cash, but depreciation, so non-cash wear and tear on historic capital invested, is the main reason why this cash generation has not converted to a profit in the half. We've also chosen to use our cash to continue to invest 196.9 million, about level to last year in the half, mainly in data and loyalty capabilities, enhancements to our customer proposition, particularly online, efficiency activities under our Lean Simple Fast programme, and maintenance and refurbishments. Our borrowing levels remain unchanged and at historic lows at 650 million. We have 50 million due to be paid back later this year. 3/4 of the interest rates on our loans are fixed. We have agreed the terms of our triennial pension valuation with the pension trustees. The review concluded our pension fund was in surplus at the valuation date, which was 31st of March 2022, but also in surplus a year on from there at March 2023. This means the partnership will no longer need to make additional deficit repair contribution, and that will save us £10 million every year. I shall now hand over to James to talk about Waitrose.
Thanks, Bae. James here for Waitrose. Morning, everyone. So despite a number of obvious customer and economic headwinds, I'm really pleased to be sharing on what I think is a strong half of performance for Waitrose. I would probably highlight especially strong customer growth, the impact of our efficiency programs driving a £73 million improvement in profit, and we finished the half with great momentum. So our sales were up just over 4%, but within that our shop like-for-likes were plus 6.4%, as we delivered £100 million of price cuts for customers and maintained the best customer service in the market, and also reminded customers that we were proud to have the best animal welfare standards in the world. In a market with significant inflationary impacts, we think volume of sales is a clear indicator of customer advocacy, and I'm really pleased to say that our volumes returned to growth as the half progressed, and we've begun to grow volume market share, even accounting for the discounters. Customer growth was also significant, and this is the 6th consecutive quarter of customer growth at Waitrose, as more and more customers are choosing Waitrose despite the cost of living challenges. And I'd point out that that number doesn't include all the extra customers shopping with us through our new partnerships with Deliveroo, Uber Eats, Shell, Welcome Break and Dobbies. We're making material progress on reshaping the business to be more efficient and profitable. So sales were up 4%, but trading profit was up 17%, and that is despite investing £100 million in price for customers. And that profit improvement is a result of hard work across all the teams driving efficiencies, but especially in our retail operations and buying. These efficiencies will now be the fuel for more investment in customers, products and shops going forwards. It's fair to say that customers are still shopping savvy, so more own label, more promotions, making savvy choices in the shops. We invested, as I said, a record £100 million of price cuts, and customers reacted by buying more and more often. Sales of our meal deals tripled year on year, with comfort food like chicken Kiev and stone-baked pepperoni pizzas leading the charge. And more recently we launched the sandwich meal deal, and we're already selling twice as much as we expected within the first few weeks. Customers are also using our unique counters to save and treat themselves. So increased sales overall, as customers might use counters to control portion sizes, but at the same time we've seen sales of our super premium dry aged beef also increase as customers look for restaurant quality eating in options. I'm also really pleased to say that our Better Together programme, selling John Lewis products in Waitrose, is growing even faster than the core food offer. So in summary, a really strong performance from Waitrose, driven primarily by more and more customers choosing to shop with us. And with that, I'll hand you over to Kathleen.
Thank you, James. This is Kathleen, John Lewis Commercial Director. Our customers continued to spend on themselves, but were more cautious about big ticket items. Fashion sales were up 3%, driven by the launch of 50 new brands and the revamp of John Lewis' own brand. Beauty sales were also up 2%. Home sales were down 5%, and in tech they were down 4%. Overall, John Lewis sales were down 2%. We're not only seeing changes in what customers are buying, we're seeing changes to how and when customers are shopping with us too. They're back in shops, which are up 2%. Weekends are back. Customers are really making a day of it, and when they're in our shops, they're eating in our cafes and restaurants, which are up well over 20%. Fashion styling appointments are up 27%. Our in-store beauty services, driven by Cavendish Clinic and our salons and spas, were up 23%. And nursery advice is 17% up. Our online mix remains high at 57% as customers return to shops. Online sales declined by 4%. But we are still up 46% on pre-pandemic online sales. Our app is growing, and 19% more customers are spending on our app. While our customer overall numbers have reduced, frequency is up 2%. We continue to invest in partner training and service. Nearly 6,000 partners have attended our Training Academy School of Service within the last 6 months. We are focused on investment on customers and on service, which is a key differentiator for John Lewis. We're delivering hassle-free returns, personalisation, driving loyalty through things such as first-to-buy launches and app-only promos. MyJL member sign-ups is at 6% from the start of the year. We're also ensuring convenience by expanding our click and collect to 5,700 locations. Early in the half, we relaunched our kids and family assortment. We sell a third of the country's pushchairs and a quarter of the nation's prams. Baby for the half was up 9%. The second half is the most important half for John Lewis, and we've got brilliant, beautiful products, and we're well positioned to delight our customers. Our autumn-winter collections are strong. We continue the revolution of our own brand fashion with new design, luxe fabrics at great prices. These range all the way from a stunning leather trench to a tailored any-day coat at £68. We're leading the way with our women's wear cashmere, which is all Sustainable Fibre Alliance approved. We're introducing 21 exciting new contemporary brands in fashion, including the exclusive Viver by Savannah Miller. Our home range is bursting with new iconic products that are already selling fast, like our rechargeable mushroom lamp or our stunning leather nest sofa. This was made from the leather from our Waitrose farm. We're setting trends, and for the first time ever, our design team have chosen a colour of the season, damson. And we've got exclusive one-off pieces in this colour, including a chair by Cartel. We're also really proud of the exclusive Living and Dine collection with Urquhart, exclusively in John Lewis, made in the UK. In tech, autumn kicks off with the new Apple launch, and for the first time ever, we're supporting this with pre-order. Right now, you can pre-order the new Apple Watch on our site, and from Friday, the new iPhone. Because we know our customers are thoughtful about big ticket spending, we want to give them choice. We're expanding our ways to pay with interest-bearing credit in store and online. This is to help customers spread the cost of their purchases. But Christmas and peak are just around the corner. We know that customers are intending to spend this Christmas. Our data tells us so. Visits on the Christmas Hub are plus 30%. This year, we're expecting to sell 40,000 tickets for our Santa experience. That's 25% up on last year. We've already sold 10,000 in our exclusive MyJL presale. So in summary, we've shown growth in fashion, beauty, and shops, and we are ready for the second half. I'm going to pass you back to Nish.
Kathleen, thank you very much. James and Bay, thank you. That gives you an impression of our first half, where we are in, we believe, in good momentum. If I look at the second half then, the economic outlook still remains uncertain, but with our brands, we feel our customers want to eat well and feel good. And given that, we expect to have an improved full year performance for this trading year. And we expect to have strong liquidity, a better debt ratio, and we expect to beat the £77 million loss before exceptionals that we had last year. We expect that because we have great plans for the second half. You heard both from Kathleen and James that for both peak season and Christmas, we have exciting new products. And this is important given that 3/4 of our profit is actually made in the last 3 months of the year. The exciting products experiences that we have include, as Kathleen said, a phenomenal Christmas range, an autumn-winter range which has gone very well in terms of our collections, and we think it's the best collections yet. And in Waitrose, over 140 new Christmas products, and I've had the privilege of tasting a few of those, of which my favourite is still the delicious sticky toffee pudding, which will be available in the next couple of weeks. So we have strong plans for the second half of the year to support our view in terms of improvement. But we'll also continue to invest in our transformation, and that's very important. It's the third year of delivering our partnership plan, and as Sharon has said, that given the significant inflation that we've had, especially in the last 18 months, this will take us 2 years longer to achieve sufficient profit. But to re-emphasize, we will hit profit much earlier than that. And in terms of the 4 key areas, we continue to create a more productive partnership by simplifying our process, by improving our margin, and having better procurement. We want to continue to invest in our customers and partners, whether it be the physical estate as we have in JL in Horsham, or including the current refurbishment of the King's Road shop in Waitrose. We'll continue to accelerate our investment in data and loyalty to achieve increased personalization of our offers and more tailored products to our customers. And of course, we continue to invest in our partners and the ability for our partners to go to the Service Academy. And pay remains our priority when affordable. Accelerating technology and modernization, I think, is going to be key in the next part of our transformation plan. And I'm very excited to say that we just signed a £100 million partnership with Google Cloud, which I think will accelerate our ability to offer joint customer loyalty schemes and also faster AI technologies. As we continue to build a strong momentum in our retail business, it is important for me to stress that it is just as critical that our long-term diversification in John Lewis Financial Services and Build to Rent continue at pace. Our partnership card now is over 870,000 credit card holders. We're launching interest-bearing credit from mid-October, and we've got planning permissions in place for Bromley and West Ealing. And that Build to Rent is not only important from helping to solve the housing crisis we have in this country, but in terms of a long-term balance sheet improvement for the partnership. Overall, we have confidence in H2. We have confidence in terms of delivery of our partnership plan, and we think we have not only the right momentum, but with the right plans and the right team in place to make that happen. And with that, I'll pass back to Chris.
Thanks very much, Nish. We've now got time for questions, everybody. There's a lot of you joining via mobile phones, so when you do ask a question, could you please let us know who you are and which organisation you're from. To raise your hand on a mobile phone, you'll need to press *9. So very happy to take any questions. The first question we have is from William Woods. William, your lines are open.
Hi, good morning. Thanks for taking the question. I'm from Bernstein. I just have a question on pricing and the competitive environment. How are you seeing pricing and competition play out both in grocery and in general merchandise? And are you worried about deflation at all? Thank you.
James, do you want to pick that up?
Yeah, no problem. Hello, William. So grocery is, as always, exceptionally competitive. You've seen everyone talk about price, talk about controlling price. So no change really there. Only the dynamic on inflation has changed some of the numbers, but grocery is always exceptionally competitive. In terms of inflation, deflation, I don't believe we're going to see deflation this year. What we'll see is inflation slowing into the lower single digits by the end of the year, assuming no more shocks to the system. That would be our best guess.
Hi, this is Kathleen from a John Lewis perspective. So on our own brand, we've only increased our prices this year between 2% and 4%, which is well below inflation clearly. But then from a cost perspective, well, we have seen freight come down significantly. From a cost of goods and materials, it's a mixed picture in that, you know, cotton prices have come down, but things like timber have not. So that's the picture for us.
Excellent, thank you.
Thanks for your question, William. We next have Charlotte Barry, who's calling from JP Morgan. Charlotte, we're just unmuting you. You should be able to ask your question now. Thanks.
Hi, thanks very much. I have two questions, please. One of them is actually a follow-on from that previous question on John Lewis and general merchandise. So that's, I guess, what you're doing with own brand. Are you hearing anything from your brand partners on pricing and what their strategy is, perhaps looking into next year, whether they're pulling back price increases or potentially even looking at reducing prices? I don't know if you'd rather I go one by one.
Yeah, well, I can start on John Lewis, and actually, you know, Our brand partners are constantly evolving their prices. Obviously, within the tech market, there's a lot of fluidity there. But I think what's been a good indicator is actually the recent Apple launch, in that they've maintained prices on, within their launch, only a couple of price increases within that. So, we're not hearing about massive price increases, and I think Apple is probably a really good indicator of what's to come.
Okay, thanks very much. And then another question on John Lewis, please, and on home. So the caution you called out around big ticket purchases, that's obviously been a theme basically for most of the year. Is this something you're calling out specifically now because it's continuing to get worse? And I'm thinking specifically in the context of rising mortgage payments and rents as we've seen them kick in over the summer.
So actually, there's a couple things that we need to unpack there. I actually think we saw home actually improve in the second quarter, and actually we gained a bit of market share in the second quarter, especially in furniture. So we're also making propositional changes with interest-bearing credit to enable our customers to spread the cost of those big ticket items. But certainly our customers are being affected by that squeeze on mortgage interest rates. But we're prepared to help them through it.
Thank you, that's really helpful.
Thanks, Charlotte. We're next going to move to Andrew Gwynn, and Andrew's from Exane BNP Paribas. Andrew, you should be able to ask your question now.
Yeah, hopefully you can hear me. Two questions if I can. So we've obviously heard seen some speculation about the partnership potentially taking in some outside equity. So any kind of thoughts there? And then the second, just on going back to Waitrose, quite a significant improvement in the volume story. If you could just help us understand that a bit better. I appreciate there was obviously some price investment, but any extra colour would be great. Thank you.
Hi, Andrew, it's Sharon. I might take the first part of your question on external finance. Obviously, there was a lot of debate following NG results. I think it's important to say that the partnership for a long time has partnered with external partners, particularly when we're growing a new business, where it's a question of sharing capital or sharing capability. So in the past, Ocado was a very good example of this, set up as essentially a separate private entity with ourselves and Ocado as joint shareholders. Probably the best current example of this is Build to Rent, which is obviously, we were in housing a long time ago, we're going back into housing, and we're doing that with Aberdeen, the investment fund. Again, it's a very good example of sharing of capital, brand, expertise. So what you will continue to see, and we've always talked about partnerships for growth, you will continue to see us finding creative ways, working with others to bring in external capital in the right way for them and for us to modernise the transformation. New deal with Google over the summer is probably the latest example. Probably the main point to underline, in case there's any doubt, which is we will always remain a partnership and a membership organisation, as not least as mandated by our trust deeds, but also it's something we are all very, very strongly committed to.
James?
Andrew, so on Waitrose volume, I agree. I think it is a really positive picture, especially with momentum going into the second half. Just to contextualise, we started the half around -7 on volume, which isn't that dissimilar to the rest of the market, but we've ended the half positive on volume and positive on volume share compared to the market, including the discounters. So that, I think, is a real sense of momentum in the business. On why, it's never possible to completely distill it, but I suspect strongly it's a combination of customers appreciating and responding to our price cuts. So that's existing customers buying a bit more with us and new customers reappraising. We had good availability through the first half overall, and that always helps drive volume. We were sharp on deals. We've talked about meal deals, especially tripling in sales, and I think at the moment with the eating in versus eating out, those meal deals are really attractive to our customers, and we had really strong shop standards through the half as well, and I think providing a really good consistent customer experience has helped us drive those volumes. So like I said, we've got good momentum going into the second half on volume, which is really pleasing.
That's very good, thank you. And then just on the exit rate for inflation, presumably that's also supported volume a touch as well. Obviously, it's not the key driver, but one of.
Yeah, so in grocery, the headline still out there is around 12%. You saw that from IGD BRC a little bit this week. As I said, customers are shopping savvy, and they have done all the way through. So actually, our exit average item price change at the end of the half was much nearer 6%. So customers dialing out some of that with own brand, with promotions, and being careful about what they buy and how they buy it. So I think, as I said, we continue to see that gradually falling across the market. And as I said, I expect average item price to be down to low single digits by the end of the year.
Okay, very clear. Thank you very much, both. Thank you.
Thanks for your question, Andrew. And that's the end of the questions for today. If you do have any follow-ups, please do ask us. The Treasury team and the External Relations team are on hand. Contact numbers are... Oh, sorry, we've got one more from Neil Keeney. Neil, do you just want to say where you're from and ask your question, please? You should be unmuted now.
Yeah, hi guys, can you hear me okay?
Yeah, we can.
Great, thank you. Yeah, Neil Keeney from JP Morgan as well. Just a question on your financing. I know you've got the 50 million repayment due later this year, but on your first bond maturity in Jan 25, any thoughts on whether that will be refinanced or whether you would redeem that with available liquidity at this stage?
I picked up. Hi Neil, it's Babe, Finance Director. So we haven't decided yet, certainly have nothing to announce around that today. We're considering options on the financing. What we know is that we have strong liquidity, and we're considering how much of that to keep to invest ourselves in our partnership and put our own cash towards that rather than other investments, as Nish has highlighted earlier. But we're keeping options open at this stage because we have historically low levels of borrowings. Our options are quite wide.
Great, thanks for that. Appreciate it.
Great. Well, that concludes today's call. Thanks very much for your time. As I said, if you do have any follow-up questions, please do get in touch with the External Relations team or the Treasury team, and contact details are on the release. But thanks for your time today, and we'll speak very soon.